I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Today's guest is someone who combines well above average intelligence with an approachability and a willingness to study and cover risks that many of his peers can't or won't consider. Ryan Mather is CEO of Ariel Re, a business that has positioned itself at the cutting edge of exciting emerging classes, such as green energy and cyber reinsurance, while at the same time maintaining an edge in more traditional lines, such as property cat, all within the Lloyd's platform. All this makes him something of a breath of fresh air. He's also frank, open and direct, but disarmingly charming. These are ingredients that make for an excellent podcast. In this episode, we get to grips with the state of the market from Ariel's point of view. Nothing's off the menu, and here we discuss topics as diverse as solar energy, artificial intelligence, the new Lloyds, and how investors currently view balance sheet businesses. Ryan's one of those people who make you feel a little bit cleverer every time you meet them. Listen on and see what rubs off onto you. Enjoy the podcast. Ryan, welcome back to the Voice of Insurance.
Thank you very much, Mark. Good to be here.
We're sitting in very new, well, they're not very new, but they're new for you. We were in older, less exciting offices than we are in now, but we're right where the Fire of London started. Goodness knows how many years ago.
Yeah, I think you're too polite to say less salubrious offices. We've upgraded definitely as we've moved from being a startup to a more established company.
Well, you weren't really a startup, though. You were already reasonably well formed.
We were a 16-year-old startup, but we definitely wanted to generate the startup energy, and so that's what we presented to ourselves.
I suppose it was a completely new impetus, new energy, I suppose, wasn't it?
New everything, new shareholders, new style of doing things, new position in the market, and a lot of new colleagues as well. So very new.
The market's really interesting at the moment. Why don't you walk us through it from your perspective?
Sure. We think that pretty much everything we do is attractive at the moment, so we're very bullish on life. Headline line of business is property.
No, not life.
Sorry, not life, only non-life, exactly right.
Just
P&C,
life in general,
P&C.
life in the P&C world.
P&C. Yeah. And our headline line of business is property cat, mostly focused in the USA. I'm reading all the half-year reports at the moment from the big brokers, and they're all talking about rates off. In fact, we look at our live tracker, and we've seen rates on just a little bit this year. Not very much, but just up a tiny bit.
I suppose everyone talks from their own perspective.
Of course.
I suppose within a large pond, you can have a slightly different water temperature than everyone else, can't you?
Of course. So on the cat side, still very attractive. We saw prices go up, on our book again, late 40% last year, another couple of percent this year. So that feels like we're in a good spot there. All the other lines of business, and remember, we only write 4 in total. So cyber, on the quota share side, the direct prices are coming off all of a sudden because I think they went up so high in the previous 2 or 3 years. Marine energy is looking good, and clean energy, which is a very esoteric line, very different for us. So we're not really competing with anybody, and we're not doing very many renewals. So it's difficult to know what the price are doing, but they're still very attractive.
They're not renewals because they're such long-term contracts.
Exactly right.
So everything's pretty good. Cyber, not worried about that. And again, that seems to be a very reactive market, that if it's reacting to lower loss experience, it will come down in line with that.
Yes, cyber's going through its own little life cycle at the moment. As you know, it's a relatively new product. And we had a whole range of products maybe 4 or 5 years ago. And I think we've slowly but surely bringing them back together to fewer of those. And prices went up hundreds of percent. Post-COVID, there were a lot of ransomware claims, etc. And it turned into a super attractive line of business for everybody in the whole value chain. So we're not surprised to expect a little bit of competition, and that's exactly what's happened. From a reinsurance perspective, I think supply for the first time exceeds demand in a long time. And that's because the traditional product, which is pro rata, the clients are buying less of that. The orders are shrinking from 50 or 60% down to sort of 30 or 40%. So the reinsurers are having to figure out what else to do. So the next products, aggregate stop loss, which is what we've been doing a bit of, and then really we're pushing the occurrence cat type line of business. And there we're selling more, but it's still slow. I think people are still trying to understand the product more and more. So there's an educational process attached to it, but we're very optimistic that it's going to come good in the end.
You've been pioneering these cyber cat lines. It sounds like the natural maturity of a new class of business is a huge amount of proportional to start with, as everyone gets more comfortable with what the big events might be, and they get much more comfortable with the sort of day-to-day block and tackle side of the risk. Reinsurers move into a different place, and everyone's happier with defining what an event might be, how large that might be as well.
Exactly right. But not everyone's entirely comfortable at the moment. If you can imagine, if you're
I can see why.
If you're a buyer and the board asks you what protection you have. If you can't articulate that very, very clearly to the board, then that's existential to your job. So you're probably not going to go down that route. So I think a bit more education required, but people are definitely moving in that direction. I think the original carriers are getting more used to the loss ratios that they're generating as well, because there was a lot of fear post-COVID and post-ransomware that we didn't really understand the product quite as well as we should have done. I think people are getting more confident about that now.
I suppose we're just another few years into a huge amount of investment into the modeling of this and the understanding. When you first think about cyber, you think that, well, goodness me, it's nothing like the real world. There is no geography. There are no natural ways of controlling your aggregations or diversifying. But then you suddenly realize that, of course, it's systemic, but everyone runs different systems and everyone has different versions of the same software, and no two corporates are exactly the same, or no two cloud providers are exactly the same. So there are natural diversifications within different digital territories rather than other things. So there seems to be the understanding's got better. But is it more that the buyers aren't quite ready to buy the occurrence product yet? Because let's say we were talking about this 2 or 3 years ago, but perhaps when you were last on the podcast, we would have been talking about, can the reinsurance supply keep up with the demand that's coming from this very fast growing insurance product? And that could be sort of something that would make it hit the buffers in terms of its growth. Now, that doesn't sound to be the case at all.
So firstly, you've just spoken very eloquently about the cyber market, so I can get you
a job either as a
cyber underwriter or maybe a cyber modeler, because you got that one nailed as well.
Don't give me a pen, whatever you do.
I think you're exactly right. I think people are getting more confident in the product they're selling, more confident in the way that cyber will behave in an extreme set of circumstances. I think the modeling is becoming more sophisticated. I don't think it's quite there yet. It's exactly the same as cat modeling. It took a long while before
Do you think it actually requires a proper big event?
That will certainly help. I'm not sure who it'll help, but it'll help our understanding. It might not help our balance sheets for a little bit. But look, we feel that that is the natural progress or the life cycle of the products. And I think we'll see less and less pro rata, more and more aggregate stop loss, and then over time, more and more occurrence cat type covers.
Talking about the market, there's been a little bit of differentiation in the marketplace, certainly from what I've been reading about in the press and broker commentary, that the ILS market is, say, a little bit harder than the traditional reinsurance market. Is that a fair description? And if so, what's behind that?
It's a very good question. I need to ponder it for a second, but I'm not sure why.
You're very well placed to answer this question.
I'm not sure the ILS market is necessarily harder. I think you've got to break the ILS market down into its component parts. I think the cat bond market certainly has been on a tear in terms of issuance. I read a couple of days ago that we're now up to $46 billion.
I think we're hitting a record, aren't we?
Cat, which is a new record and blew away last year's, for instance. And the pricing has definitely firmed in that market, so that's good for them at least. And then you've got to think about the sidecar market, the ILW market, and indeed the collateralized reinsurance market. So all of those are in different spaces. The cat bond market tends to be at the top, the collateralized re tends to be at the bottom. So I'm not sure whether they've held up differently from the traditional market, because they're all roughly the same dollar bills trading in the same areas.
There had been a little bit more reticence that noted, perhaps in the mid-year as opposed to the spring.
Reticence in what way?
Well, holding the line more on price.
I'm not sure, because I think all of these products are either equivalent or fungible. So if you don't issue a cat bond, you can buy some top-end cover and the prices will be what the price will be, and people will compare and contrast and they'll take their pick of them. So I think we're all competing in the same great big market for capital, whatever it is for cat, $450 billion. So I don't think ILS is any harder or softer. I think transaction by transaction, trade by trade.
We're talking about ILS. You're in a pretty unique position. You're a Lloyd's-based ILS manager. I don't know if you're the only one. I mean, there are others perhaps in there, or certainly others who are known as being ILS managers who have a Lloyd's syndicate, for example. But Lloyd's has made a big effort in the last few years to be more accommodative to alternative capital structures with all sorts of different things, with London Bridge and other things. What's your assessment? I suppose you are the prime audience for what they've been doing. What's your assessment so far?
Sure. Look, the way we see Lloyd's is it's the original ILS platform, and 325 years on or whatever it is, it's still the best by a long way. And we see that Lloyd's gives us a huge competitive advantage in addition to some of the others that we have, in terms of not only the ratings, which are great, and the licenses that are great, but also the diversification that us as a property cat writer, or predominantly a property cat writer, gets from the society, because everyone else is writing motor and workers' comp and et cetera, that gives us that diversification the same way that a UK motor underwriter gets diversification from our cat lines. So that's really good in terms of the capital leverage that we get. In addition to that, we get the central fund as well. So all those things give us, we believe, a tremendous advantage over other competitor ILS managers.
It just rather belie this whole narrative that we had that Lloyd's, London, not the place for reinsurance, wanting to dial down on cat, etc. You're sort of belying that, really. Sorry to interrupt in mid-flow, but this is just a reminder that you could be advertising right here, right now, and getting your message directly into the ear of key decision makers in the insurance industry. And you'll be doing it while they're absolutely in listening mode. The podcast is the medium of the future, and so is audio advertising. Contact me on mark@thevoiceofinsurance.com, and I'll do everything I can to get you started.
I think we started growing in Lloyd's at the right time when the market's hardening, so that's given us some pretty good results in the last 2 years, despite the fact that we had Hurricane Ian in 2022. So we've been able to grow materially, we've been able to attract capital to Lloyd's, and we've been able to use London Bridge, which is one of the innovations that Lloyd's put together for the likes of us. And London Bridge brings not only some tax advantages, Lloyd's had to discuss all that with the government, the UK government, HMRC, etc. And really the flexibility that London Bridge 2 brings, we've only really scratched the surface. We've done a lot, but there is still much more to do in terms of structuring of risk, etc., and the ability to attract capital in different ways. So
there's a lot more to come. It doesn't need further tweaking. What they've built is something you could just use more.
What we currently have is great, but it's London Bridge 2, and I'm guessing that with a little bit of thought, there might be a London Bridge 3. I've never discussed that with Lloyd's or indeed anyone else. But yeah, things can always be made better.
But from the tone of your voice, it sounds like that if you suddenly realised there was something that would require a London Bridge 2, it sounds like it's something that's eminently possible.
Sure. And we're in constant dialogue with the Lloyd's people, so we all know what we're attempting to do and we'll figure out the best solutions.
So very good report card on Lloyd's and the UK regulatory environment in general. What about regimes elsewhere? Are they doing enough to facilitate some high-quality reinsurance that you're providing?
There are lots of different regulators around the world, and they all do different things in different ways. The ones that really affect us are the US state regulators, where if you look at what's happened in the state of Florida in the last couple of years, the legislative changes have been very, very positive for the insurance industry. And we're seeing the tangible effects of that now as more and more money is flowing in and taking advantage of the new environment that Florida is presenting. So I think that is a huge success, and we hope that other regulators do something similar. Florida Systems, which was the market of last resort supposedly, had 1.4 million policies. I think that's going down much more towards 1 million now as more and more private companies come in and depopulate.
So it's been another success.
Huge success, yes. And that's the politicians and the regulators listening to the reinsurers and the insurers about what we need to do to help us all be successful. And here we are.
So more of the same from the other 49?
Of course. And look, we are fortunate enough to be in contact with some of those regulators, and they're all listening hard, and we hope that they enact in the same way as Florida did.
You mentioned before about your clean energy book. What's your assessment of it so far? Obviously, this is a very long-tail business, long-term business. How's it going so far? I suppose often it's easy for you to say then it's far too early to say.
Well, the first thing to say is that we're delighted that Jan Napiakowski, who's head of clean energy, we've now rebranded as Ariel Green. He's just become a father for the first time, so we're very excited about that. In fact, I think he's the 6th Ariel baby born this year. So that, I'm going to go off at a little bit of a tangent here, that I think babies are generally born when things are good. People feel comfortable in planning for those big family events. So I think that suggests that we're in rude health, not just physically, but also in a good spot as a company.
And I suppose, yes, if you're helping making a better planet for those children when they grow up, they're the ones who are going to hopefully reap any benefits that we were helping to sort of sow right now.
Yes. And sorry, back to the question.
Yes.
The clean energy business is in great shape. As I said, we rebranded it late last year as Ariel Green. And I think that was important because when you're attached to a company called Re, people don't, in the clean energy space, they don't really know what that is. So we've got a nice green new logo that looks something like the rest of Ariel's, although we're red. And I think people are listening a little bit harder. So the guys are doing a great job. We've generated a lot more opportunities. They're working very hard. We built a consortium in Lloyd's a couple of years ago, and so that's now in its 2nd year. And we have 7 or 8 partners who are also taking advantage of the clean revolution.
Yes, and of course, Lloyd's is encouraging those, obviously, within the regime, within changes in the regime.
Very much. So another example of Lloyd's forward-thinking, effectively.
Yeah, because so they can allocate a certain amount of capacity to this.
I'm very pleased to say that we still have a 0% loss ratio. Yes, it does have a long tenor to the policy, but 0 is better than any other number.
So within that, what are the kind of core risks that are being insured there?
So our group of people are mostly chemical engineers. So we like to stick to the chemical processes. So that tends to be solar, biomass, and battery storage. So those are the 3 technologies that we cover. And within that, there are a lot of project-based deals. So they might have a 7 to 10 year period attached to them where the thing is running at its full speed because it's been tested, etc. And we're just guaranteeing the technology won't fail. Or if it does, we will pay out on a parametric basis.
It's the sort of thing where the financier is saying, well, goodness me, yes, if this produces X megawatts, that's fine because that's going to make so much revenue and I can put that into my calculations. But what I can't do is if it suddenly starts producing only 80% of it, or after 7 years, it's 60% of that, and it's not something because it's degraded in some way, that kind of thing.
Precisely right. So it's really enabling funding to be more confidently attained.
Yeah, so which is obviously, I'd say that's one of the really virtuous things that the insurance industry can do because it can help multiply the amount of money that the bank can lend.
Exactly right. Again, the insurance industry is absolutely essential to world trade, etc. And this is another example of that.
I think we couldn't be sitting in 2024 without mentioning AI. What's your approach to it? I mean, how far do you think we could take humans out of the underwriting loop and other things? Well, what are the best use cases you've found? I'm sure you're using it in some way, or people within your organization are all using it.
Yeah, so AI is a very broad term that's being thrown around at the moment. So I'll just give you an example of how we think about things. Number one, we want human beings to be doing human being work, so not rote tasks. They might do that at the beginning of their career, but very quickly they're going to get bored of that. So we want them to be doing heavy thinking because that's what our humans are quite good at. A few of the words that we use within Ariel: focus, simplify, because if we simplify things, then it becomes automatable. Then the next part of it is automation. So we think long and hard about those rote tasks that human beings were doing, and we try and make sure that a machine can come in and replace them. That means that we can generate operational leverage. We still have the same number of people in our team as we had 3 years ago, writing twice as much business, as a for instance.
Yes, so productivity is a big deal. So that's already 100% productivity gain.
Exactly right.
And do you have more penciled in? Do you think you could do 3 times as much with the same number?
I don't see why not. And then, that's really more the back office side of things, the nuts and bolts. On the underwriting side, we've always used some sort of algorithmic underwriting, and the underwriters do a wonderful job, but there aren't many of them that can run 10,000 simulations in a minute in their head. So we make sure that we augment the smart human beings with the best tools to underwrite.
So do you think it's more about productivity, or is it going to be more about the other kind of productivity that comes from skill, increasing the skill of the underwriter? Where's that balance tipping?
It will continue to evolve. If you go back to pre-cat models, the underwriter was everything. They were trying to work out all the rates, and they used their PMLs, ratios, etc., against aggregates, and the world was a very different place. Then we got to cat models, which were working out a price, and then we had cat models helping with the capital as well. So the machines are going to keep encroaching, and the human beings will have to do slightly different things to earn their crust. But I don't think human beings being replaced is on the horizon as soon as other people are talking about.
Yes, it sounds like you want to be a human-based organization.
Absolutely.
What about the brokers? What do you think they should be doing? The best broker is always going to be sort of reverse engineering everything you do. Is that their job? I've had other underwriters say to me, well, that isn't really their job, because at some point where everything, particularly when the price is going to be the price, and obviously the band in which the price sits is going to get narrower, one presumes. There's going to be less outliers the more rigorous we all are. Okay, we're going to have different methodologies because hopefully we're going to come to similar numbers. And I suppose that the price range of the market is going to be less varied, and there will be less sort of, slightly way off the charts kind of ones, or either below or above. And that the broker, I suppose, is actually going to be freed up because the price isn't going to matter quite so much, that they're going to be freed up to actually go and do the job of holding the client's hand and actually giving good advice to the client, because the execution will be a very small part of what they do. Do you think that would be right? Is that the right sort of theory?
Possibly. Again, I need to contemplate it a little bit. From our perspective, the brokers are our distribution channel. So from our perspective, we want them to bring us risk that is well priced within our appetite. So we spend an awful lot of time talking to the brokers and allowing them to understand at a very detailed level what our risk appetite is, so that they waste as little time as possible.
So you're transparent. You're not saying, hey, no, put it in my black box. I'm not telling you, and don't come anywhere near my black box. I suppose they find out what comes out of the black box anyway.
Yes.
So you must explain to them.
It's about efficiency. And of course, the brokers like us, they want to do more for the same or more for less. So I think that'll be helpful.
So it's all about freeing them up to be more productive themselves. I suppose we can't be more productive if our brokers aren't more productive. You can't be more productive as an underwriter if your broker's not able to keep up. Because we're trying to do 3 times as much business, but if you don't get sent 3 times as many risks because they're really, really struggling.
No, but I think it's, as a company, us knowing exactly what our risk appetite is, being able to articulate that very clearly in both words and in numbers so that they know exactly what we're looking for and they can come to us in the most efficient way.
I think that's a very reasonable way of looking at it. Actually, looking at fee-earning businesses, intermediaries, brokers, MGAs, that kind of thing, we've had this trend over the last few years, certainly, that investors have been valuing those fee-earning businesses more highly than balance sheet-owning businesses. Then maybe that's changed a little bit. We've had a little bit of a re-rating in the more traditional insurance balance sheet and reinsurance balance sheet world. Do you think that change that we've had, is that a permanent one, a secular change, or is it something that might sort of ebb and flow?
I think capital is generally pretty rational in how it allocates. So for the past 5 to 10 years, balance sheets have not performed very well, and therefore capital has been reticent to buy into it. Whereas the distribution part of the network has performed really very well, and therefore the flow of capital and the valuations that have come from that have been really quite high. So in the past 3 or 4 years, I think we've seen re-rating of the balance sheets. So the prices have gone up, I've already said, on property cat. For us, it went up by 50% or something, and probably 100% from the low points of 2017 and 18. So now our results should be a lot better, and hopefully over time that will also attract more capital. There's another aspect to it, which is volatility. And we are in a business that is inherently volatile. And that is something that has been really punished by the public markets especially, and also somewhat by the private markets too. And volatility, people only ever think about it in one dimension. It's generally bad volatility. You've had 130 or 150% net combined ratio. But in fact, we hope with current prices, we're going to generate some positive volatility as well, where instead of having a 95 or a 92, we can have a 50 or a 40 net combined ratio, which is what we saw last year. And I think if we can have more of those years, which is what we had at Ariel at the beginning of our life, I think then we will attract more capital back and we'll attract a higher rating, etc.
I suppose, and also what's returned only in the last couple of years has been some real interest rates. Now that inflation's come down, say in the UK, you can get 5% on your cash and there's only 2% inflation. That's the first time since about 1999 that has been possible. That I suppose in a safe saving environment, if you look at an insurance company, there's a big pot of money that has to make sure that money is still there. It can't take lots of risks with that pot of money because it's there to pay claims, quite rightly. Then I suppose, do you think that return to a real interest rate environment might also make you more attractive just simply because you're going to make lots more money on your investment?
Sure. I remember when I was a young analyst in Lloyd's 20 odd years ago when interest rates were higher, and I used to observe that for most P&C syndicates, you would have your expenses and your investment income would just about wash each other out. That obviously went away in the low interest rate environment. We're not quite back there yet, but yes, we're earning some pretty good money on our investments. That, of course, is both us and the distributors as well. They get to keep some of the money for some of the time, so they're making some return too.
I suppose as a manager, part of your business is fee earning anyway. So,
of course it is.
So back to that question. So you think it's something that's now washing out? Obviously, brokers and intermediaries and MGAs are naturally, a lot of them are very attractive businesses. They're great businesses, but they're different from balance sheet businesses, and balance sheet businesses are becoming more attractive. Would you say that they become equally attractive?
I'm not sure we're there yet because,
they're different,
because the brokers and the MGAs have had probably a decade of really solid growth and really solid earnings. Whereas if you take the property cat market, we've had 1 year in a row so far. And with climate change, etc., it's still to be proven out whether we can make the returns consistently year in, year out.
So yes, if we're in 10 years' time and you've been getting your 40 combines every year, obviously warning investors that it could be 150 on a really bad year, then obviously
if we get 40 every year, then we've got a different problem because, of course, we'll come under pressure. But look, over the course of time, we expect to have maybe a combined ratio that begins with a 7. That would be a pretty attractive place.
You're in 5th year of this new Ariel Re with your current owners. 5 years is sort of 5 years, 7 years sort of itch, isn't it, when you have private equity ownership? So should we be preparing ourselves for a sort of swap out of investors?
So firstly, I think it's 4 years.
4 years. Sorry, yes, yeah, I'm terrible with my years.
4 years in November. So not quite the 5. But look, our main shareholders are Pelican Ventures, whose holding time horizon is probably a very long time. And then JC Flowers have a minority, and they've been with us for nearly 4 years. And probably the clock will be ticking for them to do something. Now, they're a minority investor, so they might look for a mark or something, but they won't be disruptive to the business. They've been a wonderful supporter.
To be just the same as if you're a public company, then obviously your shareholder base changes all the time.
And they've done very well out of their investment, which they generally do, seemingly. So we're very happy to have them, and we'll have them as long as they want us.
But it's unlikely to be something disruptive when we talk about a capital event. It's unlikely to be more of a non-event.
Absolutely, yeah.
Ryan, I've really enjoyed talking to you. I've come to the end of my questions. Anything you want to add that you think we've missed out, or something that's been inspired to share with us?
Nothing obvious. So thank you very much for being gentle on me, and very much enjoyed the conversation, and look forward to the next one in a couple more years.
Thanks very much. Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.